Good morning. This is Jim Harvey, president of Opus 111 Group, and this is Your Money Week. Today, Monday, the 28th of March, the market is a little bit freaked out about the fact that the 5-year Treasury has inverted, meaning it's yielding more than the 10-year and depending on what minute you're looking at it, the 30-year. As you can see here, and these are real-time quotes, I mean, the 5 years at 253 and the 30 years at 256. So it hasn't inverted against that, but it has inverted against the 10-year, which is the bellwether, a U.S. Treasury. It's the most, liquid security in the world. And so often what people will do when this occurs is they suddenly start extrapolating, oh my gosh, that means that, we're going to have a recession. That's not the case. I mean, these things, if you listen to the pundits every day, they are constantly looking for hooks to get you freaked out and all this stuff. It is an indication that people are selling their 5-year paper. Now, why they're doing that, unless you talk to each one of them, you don't really know why. But what it is saying is that the bond market, when people sell bonds, what happens is yields go up. And so a normal yield curve, has lower rates at the bottom and slowly rising up. Whereas in this case, you've got an inversion, and that is sometimes a trigger of a coming recession. We don't see that at all. And again, this is another example of people freaking out over the statistics, and the headlines are compelling. So for example, here is a chart of inversion spreads. The last time we inverted was right here in beginning of 2006. And so, oh my gosh, the world's coming to an end because we're down here. Look, we're not in the same position as we were in 2006. We hadn't gone through the credit crisis of 07 to 09. As you can see here, the spreads widened out quite a bit. Even looking at 2020, I mean, the spreads widened and then came way back down. So my overall feeling about this and what I think you ought to focus on is not what this particular factoid and extrapolating it to death. Look at the underlying economy, and the underlying economy is still pretty darn sound. We are coming out of this COVID thing. We've got a lot of supply chain disruption. There is a rotation going on from the large cap growth tech names that have basically led the market since 2009 to value. Inflation is clearly more of a factor. That's probably got something to do with it. But my last point is this. A lot of people say, well, my gosh, the Fed's, controlling interest rates. The Feds do not control interest rates. Yeah, this is one of the biggest misconceptions in our market. The Fed sets 3 things. They have 3 tools in their quiver. The first is to set the margin requirements on how much member banks have to have on deposit with the Fed, plus how much you can borrow against financial assets. That doesn't affect interest rates at all. The second is they set the Fed funds rate, which is the short-term rate at which member banks, and only about 38% of U.S. banks are members of the Fed, but it sets the rate at which those member banks can borrow from the Fed. That's been 0 for a long time. That's the thing when people are talking about, well, the Fed is raising rates. They're raising that Fed funds rate. It's the only rate that they determine. They do not control the interest rates in bonds, in government bonds, corporate bonds, muni bonds. The only way they do that is their third tool, which is what's called open market operations. And you might have read about the Fed balance sheet, and we've talked about this in previous sessions, that the Fed balance sheet has doubled to almost $9 trillion. That is open market operations. So how does that work? If everyone else is selling, then the Fed is the buyer of last resort. So that keeps the interest rates from going way up. But at this point, with $9 trillion on the balance sheet, they don't have as much borrowing power as they might otherwise. And so therefore, you might think that we're going to see some more of this disruption. So, bottom line is the fact that, there's a relationship, real or imagined, between the 2-year and the 5-year, or the 2-year and the 10-year, or the 5-year and the 10 or the 30-year. I mean, these are interesting, but just the fact that it inverts does not mean that we're going into a recession. We do not believe, and the economists that we follow closely do not believe that we're going into a recession. We're a long way away from that. So, this may be a buying opportunity, but in any case, don't sweat it. This is Jim Harvey, president of Opus 111 Group. This has been Your Money Week. We invite you to go to our website, to our Learn page, to get access to more blogs, video and audio podcasts and the like, which hopefully you'll find of use. Have a great day.